Preparing for a financial analyst at SoftBank interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at SoftBank? SoftBank appeals to me because its analysis combines corporate finance, technology investing, and strategic capital allocation. I would enjoy evaluating businesses across different growth stages, understanding their unit economics, and translating market developments into investment conclusions. The company also offers a distinctive perspective through both operating assets and portfolio investments. I can contribute strong modeling discipline, curiosity, and concise communication while continuing to develop judgment around valuation, risk, and long-term value creation. While answering, connect your analytical skills to SoftBank's technology focus, investment portfolio, global scale, and ability to combine operating businesses with investment activities. Show genuine interest rather than relying only on brand recognition. Question 2. Walk me through your financial analysis process. I begin by clarifying the decision the analysis must support, because a valuation exercise differs from a budgeting review. Then I collect reliable operating and market data, normalize historical performance, and identify the business drivers. I build a transparent model with documented assumptions, test downside and upside cases, and reconcile outputs against external benchmarks. Finally, I summarize the recommendation, key sensitivities, and unresolved risks so decision-makers understand both the answer and its limitations. Make sure to cover defining the decision, gathering reliable data, normalizing historical results, building assumptions, analyzing scenarios, testing sensitivities, and communicating a conclusion with risks and recommended next steps. Question 3. How would you value a high-growth technology company? For a high-growth technology company, I would triangulate rather than rely on one method. I would forecast customers, retention, pricing, revenue growth, gross margins, operating leverage, and cash needs. Trading multiples provide market context, while a DCF can show long-term economics, though terminal assumptions require caution. I would also examine unit economics, dilution, and downside cases. The final range should explain what must be true operationally for the valuation to be justified. In your answer, discuss revenue and margin drivers, comparable companies, precedent transactions, DCF limitations, scenario analysis, customer economics, dilution, and the importance of matching valuation methods to maturity. Question 4. Explain the three financial statements and how they connect. The income statement shows profitability over a period, the balance sheet shows resources and financing at a point in time, and the cash flow statement explains changes in cash. Net income flows into retained earnings and begins operating cash flow. Depreciation reduces earnings but is added back in cash flow, while capital expenditure increases assets and reduces investing cash flow. Financing activities change debt or equity, and the ending cash balance must reconcile to the balance sheet. Be sure to mention the income statement, balance sheet, and cash flow statement, including net income, working capital, depreciation, capital expenditure, debt, cash, and retained earnings linkages. Question 5. What is the difference between enterprise value and equity value? Enterprise value represents the value of the operating business available to all capital providers. To bridge from enterprise value to equity value, I subtract debt and debt-like claims, add excess cash, and consider minority interests or preferred equity where relevant. EV-based multiples, such as EV to revenue or EV to EBITDA, compare operating performance before financing differences. Equity multiples, such as price to earnings, measure value attributable specifically to common shareholders. Focus on the valuation perspective, the bridge between enterprise value and equity value, debt, cash, minority interests, preferred equity, and why analysts use EV-based versus equity-based multiples. Question 6. How would you build a DCF for a technology investment? I would forecast revenue using operational drivers, then estimate margins, taxes, capital expenditure, working capital, and other reinvestment to derive unlevered free cash flow. I would discount those cash flows using a risk-adjusted WACC and calculate terminal value through a perpetuity growth or exit multiple approach. Because technology valuations are terminal value sensitive, I would present a range, stress growth and margins, and clearly separate business assumptions from market assumptions. Make sure to cover revenue forecasting, operating margins, taxes, reinvestment, unlevered free cash flow, WACC, terminal value, discounting, sensitivity analysis, and appropriate treatment of stock-based compensation. Question 7. What makes SoftBank's investment analysis different from analyzing a traditional company? SoftBank requires analysis at both the asset and holding company levels. An analyst may assess an operating segment, a listed investment, or a private technology company, then consider ownership, debt, liquidity, and portfolio concentration at the parent level. Private holdings introduce valuation uncertainty, while market prices can change rapidly for listed assets. I would therefore combine intrinsic valuation with an asset-based perspective and explain how financing and discounts affect value available to shareholders. Discuss portfolio complexity, public and private holdings, holding company considerations, valuation uncertainty, financing structures, portfolio concentration, operating segments, and the need to distinguish asset value from parent company value. Question 8. How would you analyze a company with negative EBITDA but strong revenue growth? Negative EBITDA is not automatically unattractive if growth creates durable economic value. I would examine gross margin, retention, customer acquisition cost, lifetime value, contribution margin, and whether incremental revenue becomes more profitable. I would also calculate cash burn and runway, then model the path to break-even under realistic assumptions. Valuation could use revenue or gross profit multiples, but I would apply a discount when growth depends on continual external funding or weak retention. In your answer, cover growth quality, gross margin, customer acquisition cost, lifetime value, cash burn, runway, contribution margins, path to profitability, comparable metrics, and downside funding requirements. Question 9. What is IRR, and what are its limitations? IRR is the discount rate that makes an investment's net present value equal zero, so it captures both return magnitude and timing. A quick distribution can produce a strong IRR even when total profit is modest. IRR can also create multiple solutions when cash flows change direction more than once and assumes reinvestment at the calculated rate. I would pair it with MOIC, cash profit, downside analysis, and investment duration before drawing conclusions. Be sure to explain IRR, cash flow timing, multiple solutions, reinvestment assumptions, comparison with MOIC, and why analysts should evaluate absolute value creation alongside percentage returns. Question 10. How would you evaluate an investment opportunity in artificial intelligence? I would separate excitement about the theme from evidence of investable economics. I would assess the product's differentiation, proprietary data, customer willingness to pay, retention, gross margins, compute costs, and dependence on external platforms. I would then evaluate market size, competitive responses, regulation, capital needs, and realistic adoption scenarios. The key question is whether durable value accrues to this company, rather than simply to the broader AI ecosystem. Focus on the technology's defensibility, data advantages, monetization, customer adoption, compute economics, regulatory exposure, competition, capital intensity, and scenarios for both rapid adoption and commoditization. Question 11. How do interest rates affect technology valuations? Higher interest rates generally increase discount rates, reducing the present value of distant cash flows and pressuring long-duration technology valuations. They can also raise borrowing costs, reduce risk appetite, and compress comparable company multiples. The impact is not uniform. A cash-rich company may benefit from higher interest income, while a leveraged business faces greater refinancing risk. I would quantify both valuation sensitivity and operating consequences rather than applying a blanket percentage adjustment. Mention discount rates, terminal value, growth stock sensitivity, financing costs, risk appetite, comparable multiples, cash balances, and the difference between direct valuation effects and operating effects. Question 12. What financial metrics would you monitor for a portfolio technology company? I would tailor the dashboard to the business model, but typically monitor revenue growth, gross margin, recurring revenue, net retention, customer acquisition cost, lifetime value, contribution margin, cash burn, and runway. For a mature company, I would add EBITDA, free cash flow, leverage, and return on invested capital. I would also compare actual performance with the investment case, because a strong headline growth rate may conceal deteriorating retention, pricing, or unit economics. Cover growth, gross margin, recurring revenue, retention, customer acquisition cost, lifetime value, burn, runway, contribution margin, leverage, and metrics appropriate to the company's business model. Question 13. How would you assess whether a company has a durable competitive advantage? I look for advantages that competitors cannot easily replicate and that translate into durable economics. Examples include network effects, switching costs, proprietary data, scale efficiencies, strong distribution, and intellectual property. I would test the claim through customer retention, pricing power, gross margins, market share stability, and competitor behavior. A stated moat is not enough. I want evidence that the advantage persists through technological change and supports attractive returns on incremental capital. In your answer, discuss switching costs, network effects, scale, brand, proprietary data, intellectual property, distribution, customer concentration, and evidence that advantages produce superior economics over time. Question 14. Tell me about a time you found an error in a financial model. In one project, I noticed that projected cash flow improved despite a sharp increase in receivables. I traced the model and found working capital had been linked to revenue growth rather than collection days. I corrected the formula, quantified the valuation impact, and reviewed the change with the team before updating the output. I then added balance checks and a working capital sensitivity. That experience reinforced the value of understanding model logic, not merely checking formulas. Be sure to explain the modeling context, how you identified the issue, the financial impact, your correction process, communication style, and the control you added to prevent recurrence. Question 15. How would you perform a sensitivity analysis? I first identify assumptions that drive valuation, such as revenue growth, margin, terminal growth, exit multiple, and discount rate. I then test realistic ranges using one-way sensitivities and two-way tables to reveal interactions. For an investment case, I might combine slower growth with margin pressure and higher funding costs. I would avoid false precision, explain which variables are controllable, and connect the results to downside protection and decision thresholds. Mention identifying value drivers, selecting realistic ranges, using one-way and two-way tables, interpreting interactions, avoiding false precision, and translating sensitivities into specific investment risks. Question 16. What is working capital, and why does it matter in forecasting? Working capital measures the funds tied up in day-to-day operations, commonly through receivables, inventory, and payables. A growing company can report higher earnings while consuming cash if customers pay slowly or inventory builds. In forecasting, I would use operating drivers such as collection days, inventory turns, and payable days, then adjust for seasonality and unusual balances. The resulting cash conversion is essential for estimating funding needs and intrinsic value. Focus on receivables, inventory, payables, operating cash conversion, growth effects, seasonality, normalized balances, and the risk of confusing accounting earnings with cash generation. Question 17. How would you analyze an acquisition financially? I would begin with the strategic rationale and value the target on a standalone basis using comparable companies, transactions, and DCF analysis. Then I would estimate realistic revenue or cost synergies, integration costs, financing effects, and the purchase accounting impact. I would test accretion, dilution, leverage, cash returns, and downside cases. The acquisition is attractive only if the price leaves adequate value after execution risk, not simply because headline synergies appear large. Cover strategic rationale, standalone valuation, synergies, purchase price, financing, accretion and dilution, integration costs, returns, sensitivities, and risks that could prevent synergies from materializing. Question 18. How do you distinguish accounting profit from cash flow? Accounting profit follows accrual principles, so revenue and expenses may be recognized before cash changes hands. Cash flow adjusts for non-cash items such as depreciation, changes in working capital, and timing differences. Capital expenditure is especially important because it may not reduce current profit but consumes cash. I would therefore reconcile net income to operating cash flow and then free cash flow, checking whether reported earnings convert sustainably or depend on favorable working capital movements. Explain accrual accounting, non-cash expenses, working capital, capital expenditure, deferred revenue, provisions, and why free cash flow provides a different perspective on financial quality. Question 19. What would you do if management's forecast seemed overly optimistic? I would not reject the forecast immediately. I would decompose it into volume, pricing, retention, margin, and investment assumptions, then compare each with historical results, industry benchmarks, and operational evidence. I would discuss the gaps constructively with management and build an independent base and downside case. In the final analysis, I would show the forecast as one scenario, clearly identify what must occur, and avoid embedding optimism without supporting evidence. Make sure to cover validating assumptions, benchmarking against history and peers, asking constructive questions, creating an independent case, documenting differences, and preserving a professional relationship. Question 20. How would you assess liquidity risk at an investment holding company? I would map cash sources and uses over several years, including operating cash flow, investment commitments, interest, debt maturities, and potential capital returns. I would distinguish liquid listed assets from private holdings and consider whether assets are pledged or difficult to monetize during stress. Then I would test refinancing access, market value declines, and delayed exits. Liquidity analysis should focus on survivability and timing, because a valuable portfolio can still create near-term funding pressure. Discuss cash balances, debt maturities, interest expense, undrawn facilities, asset liquidity, collateral, cash flow generation, refinancing access, market stress, and potential mismatch between asset value and available cash. Question 21. What is net asset value, and how could it apply to SoftBank? Net asset value estimates the value of a company by valuing each asset separately, adding cash, and subtracting debt and other liabilities. For SoftBank, I would apply ownership percentages to listed and private investments, use market prices where available, and estimate private holdings with appropriate methods. I would then compare NAV with the parent's market capitalization to assess any holding company discount or premium, while stress testing private valuations and debt assumptions. In your answer, explain valuing individual assets, adding cash, subtracting debt and liabilities, ownership percentages, holding company discounts, private asset uncertainty, and reconciliation to market capitalization. Question 22. How would you compare two investment opportunities with different risk profiles? I would compare the opportunities on a risk-adjusted basis rather than simply choosing the higher projected return. I would model probability-weighted cash flows, downside loss, duration, liquidity, leverage, and key operational risks, then compare expected IRR, MOIC, and present value. I would also consider correlation with the existing portfolio and strategic fit. A lower return opportunity may be superior if its downside is limited and its cash flows diversify concentrated exposure. Focus on expected cash flows, probability-weighted outcomes, risk-adjusted returns, downside loss, liquidity, duration, correlation, strategic value, and the limitations of comparing headline IRRs alone. Question 23. What Excel and financial modeling skills would you bring to this role? I am comfortable building three-statement models, DCFs, comparable company analyses, operating forecasts, and scenario dashboards in Excel. I use consistent structures, clear assumptions, error checks, and sensitivity tables so another analyst can audit the work quickly. I also focus on data integrity when importing information and avoid unnecessary complexity. Most importantly, I can explain what the model means, which assumptions drive the result, and where judgment remains necessary. Mention three-statement modeling, valuation, scenario tools, sensitivity tables, data organization, formula auditing, checks, presentation quality, and the ability to explain outputs without hiding behind technical complexity. Question 24. How do you prioritize multiple urgent analytical requests? I prioritize based on decision impact, deadline, dependencies, and the cost of delay. I clarify the required output and minimum viable analysis for each request, then sequence work around critical decisions. If priorities conflict, I communicate the trade-off early rather than silently missing a deadline. I protect quality by using documented assumptions and focused checks, while providing an initial directional answer when appropriate and following with deeper analysis. Be sure to discuss decision impact, deadlines, dependencies, effort, stakeholder alignment, transparent progress updates, quality control, and escalation when priorities conflict or data limitations threaten delivery. Question 25. What questions would you ask before recommending a technology investment? I would ask whether the company solves an important customer problem, how large the addressable market is, and why it can win sustainably. I would examine growth quality, retention, unit economics, margins, cash needs, competitive threats, management capability, and governance. I would then test valuation against realistic scenarios and identify exit paths. My recommendation would state the core thesis, the evidence supporting it, the risks that could break it, and the milestones that should be monitored. Cover customer problem, market size, product differentiation, unit economics, growth quality, management, competition, capital needs, valuation, exit routes, governance, and downside protection. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.